Let's bring in Brett Gottlieb, Comprehensive Advisor, Founder and President, and Ted Oakley, Oxbow Advisors Managing Partner. Brett, let's start with you. What do you make of this rally? Is Santa Claus here to stay for the next couple of days?
I sure hope so. I like seeing a day like this. It was there was a lot of news out there with the sentiment report and personal spending and really personal thoughts on things, and then to add it all up, they decide to pass the spending budget, which has got a bunch of Secure Act 2.0 stuff. So hopefully this is some good news and we can continue some green into this Santa Claus rally.
And Ted, I'll give you the floor here. What are you thinking about some of the news that we got today? And I'll echo Brett's point. I think it's actually good that we're not seeing a lot of vacillations in the market. I think a lot of people would be happy to just kind of walk away and watch paint dry as opposed to watching this market another week. But what do you have to say to people who are ending the year here with their 401ks?
Well, I suppose that most of them are probably down quite a bit in their 401ks because most of them don't give very good advice, honestly. So my guess is they didn't have a lot of defensive cash type things. So if I were them and I had new money coming into 401k, I'd probably put that money in cash. But normally, a lot of times in bear markets, I've seen quite a few of them, you don't get much of a Santa Claus rally. So you could get a few days next week, I suppose, but we're not at that stage right now, I don't think.
Well, I guess I'm not getting the right advice either. My 401k is taking a beating. Brett, core PCE 4.7%. Change the narrative at all as far as the Fed's perspective?
No, I don't think so. I think, these continued topics of, recession moving forward and what we're going to see this next year. I tend to agree. I mean, we're not getting a lot of great advice for the employees out there. We need to be very cautious. We need to be defensive. The next several months and so forth are going to be challenging. You need to make sure you're doing the right kind of asset allocation. You're setting cash on the sideline if you have it, and being prepared to take care of opportunities when they exist.
Ted, I know you like cash. Can you tell me why? And does this have anything to do with the Fed? And if it doesn't, can you tell me what you're expecting from the Fed next year as well in your answer?
Well, it had something to do with the Fed in terms of if you looked at what they did in 20 and 21, that's really what caused this, what I consider a super bubble. I mean, I thought 98, 99 were really, really overpriced, but they weren't anything compared to 2021. So it wasn't surprising when you get 2 or 3 standard deviations above the norm, you're going to get some setback somewhere. And so it didn't surprise us. And so for us, when I say cash, we have it in really, really short-term treasuries, 90 days or so. So that's what I'm saying when referred to cash. But we came into the year with that. So, we haven't really changed that much. I think the worst in terms of earnings and that sort of thing for public companies is still ahead. I see the first and second quarter being very, very poor comparisons. And I don't think that's priced in the market right here.
Do you agree with that assessment, Brett? And sticking with the theme of cash, if you have some on the sidelines, where are you allocating it early into the new year?
Yeah, I have to agree. I think that you really have to be extremely cautious. We're doing very much the same thing. A lot of short-term treasuries right now. And taking advantage of the higher interest rates. I mean, we don't necessarily like that and like what the Fed is doing, kind of pushing us towards this recessionary issue. I agree, we've got these earnings challenges. So you really just have to look for the companies that are heavily beat up, that have had, not great years, be looking closely at those earnings statements and so forth, and find, where it makes sense, and don't be in any rush. I always stick to more of the traditional set of good asset allocation, find sectors that have opportunity to be defensive right now, and kind of work our way through this, and really just not try and time the market. Have a good plan and work with an advisor to set that plan up.
Ted, what does it take for you to get bullish in the new year?
Well, yeah, I think you're going to have to get the earnings to a point. I'll give you an example. Average on the street for the S&P this 23 is around $230, 231, and we think it's probably going to come in somewhere between 190 and maybe 200 at the most. And so there's a lot of adjusting to go on. So if you look at forward multiples right now, they're still relatively high, even with those numbers. But when you adjust for what we're going to see I think you have to get to a point for us to where, we really get it washed out pretty good. I mean, it's interesting to me that I haven't seen so many people, nobody's been too worried about this year, even though they've been beat up pretty good. It's kind of interesting to me. They don't have a tendency to think much about it. So we think they're going to have to get to a point where they're going to have to think about it.
All right, we'll have to leave it there, gentlemen. Brett Gottlieb, Ted Oakley, good to see you both. Merry Christmas.